STRR Royalties is an innovative carbon credit and precious metals streaming company with the world's first carbon credit royalties in forestry and regenerative agriculture through its Green Star joint venture. The company has partnered with industry leaders, including Cenovus in the energy sector and Agnico Eagle in the mining sector. CEO Alex Pernin is joining us to review the company and outline the opportunities and outlook for STRR Royalties. I'm Martin Gagel with Market Radius Research. It's Wednesday, May the 29th. Please remember this is neither recommendation or investment advice. We're here to learn about the company. Alex, welcome. This is your first time on the platform. We had Kevin McLean, your Chief Investment Officer, here a little more than a year ago. A lot has happened since then. How are things going?
It's going well, Martin. Thank you. Thank you for having us. It's good to be here.
Excellent. You've got a short presentation deck you're going to walk us through, and then we're going to flip it or more into questions and Q&A from the audience, and just a bit of a fireside chat to walk through the different aspects of STRR Royalties. So go ahead.
That sounds good. Okay, great. Thanks, Martin. Afternoon, everyone. Thank you very much for joining. Very happy to be here and sharing this town hall update, if we want to call it that, and answering all your questions at the end. I'm aware that we have a wide range of audience members, from shareholders that are very familiar with the story to investors that might be new to us. So with that, I'll speak through everything, keeping in mind that balance. But please come up with your questions at the end. I'm looking forward to it. So, as Martin said, STRR is a carbon credit and precious metals royalty company. We went public a few years ago, but the long story short is that we began with a precious metals focus, and over time we began to have a carbon credit focus, and that is the focus for us now. What that means is that we have two portfolios. I'll be referring to both of them throughout the presentation. On the carbon credit front, as Martin said, we were the first ones to do carbon credit royalties. They had never been done before, and something that most people might not be aware of is that the team today at STRR, the first deal we did as a team was the carbon credit royalty. We actually did that before we did our precious metals investments. But the carbon credit portfolio, all of that is housed under a separate vehicle called Green Star Royalties, of which STRR owns 46% of Green Star. It's the largest part of our STRR business. It's got significant growth potential. It's what we focus on every day. It is the future of the business for this team. On the mining front, this is how STRR went public. It's a good portfolio. I'm proud of it. We're going to talk about it today. It is a non-core portfolio. What that means is that we're not allocating capital to it at this time. Martin, I just want to talk a bit to the audience on the royalty model, because I'm mindful our investors know what this is. Some might not, though. The royalty model simply means that we are a project financier. It's a simple revenue sharing model. It works very well with our counterparties because there's alignment between us, the financier, and them as a counterparty. What we're doing here is we're providing upfront capital, and then we receive a percentage of revenue, whether it's from a mine or from a carbon project, over 10, 15, 20 years. It's a great business model because it gives you exposure to commodity price upside and production volume. If the mine or the project generates more of something, or gold or carbon does better, well, we get that benefit. But we don't have the exposure to operating expenses, inflationary pressures, which has been a clear problem the last few years, or having to manage these operations. It's been the best way to play gold. In the last 40 years, you would have wanted to own the gold royalty companies. I think for the next 40 years, you're going to want to own the carbon credit companies. In terms of Green Star, as a quick overview here, we've built Green Star around three key pillars, if you want to think of it that way. Invest with the best partners, invest in the best jurisdictions, invest in the best project types. So on the first point, we are a JV with Agnico Eagle and Cenovus. I'm sure these are names that are household, they're recognized, senior natural resource leaders in Canada, both 40 to 50 billion market cap companies. These are juggernaut businesses, ESG leaders in their space. I think this, as a whole point, is very impressive, the fact that we have them as our joint venture partners. We're also partnered with the best-in-class carbon project developers. I talk about Anu a lot. Anu is the largest carbon developer here in North America. In terms of geography, we have only invested and only will invest in the top jurisdictions. That's a huge differentiator. Nobody else does it like that, and I'm very proud that we are focused like this. And then on the portfolio front, which we'll get to on the next slide, these are premium projects, mostly nature-based projects like agriculture and forestry. So on the portfolio, Let's talk about green first, the green circles logically. These investments are in the US and in Canada. The largest investment for us is a regenerative agriculture program. Think of it as a sustainable way to farm. We have 3 improved forest management projects or royalties, and then we have a royalty on a clean tech business as well. The portfolio is 95% removal. So what I mean by that is there are 2 types of offsets in this world. You have removal offsets, which remove carbon out of the air, and then you have avoidance offsets that avoid the emission of carbon in the air. We're 95% removal. And the reason for that is it's more in demand and they're higher price credits. Portfolio will be free cash flowing this year on the back of a deal that we just did a month ago, and then we'll get revenue growth year over year with all the other projects coming online. On the mining side, so these are the blue circles, investments in the US, Canada, and Australia. Note that there are dots in Mongolia. It's less than 1% of the portfolio, so it's insignificant. The ones that matter, we have 2 gold investments. One is a royalty on a mine in British Columbia. One is a gold stream on a project in Arizona. And then we have a royalty on a mineral sands project in Western Australia. Attractive portfolio, generates revenue, has meaningful revenue growth for us, especially once those projects come fully online. And that is all I have, Martin, for the overview.
I think you did a record quick corporate presentation there on the front, Alex, and I compliment you on that. It's nice to have a nice, very succinct story. Just to clarify the royalty model, especially on the Green Star side, your royalties, be it gold or carbon credits, they're unhedged. So if the price of gold would double or the price of your carbon credit would double, your revenues would essentially double. You're getting the credits or the ounces coming out off of the stream, correct?
That's exactly right. So we are 1 for 1 in terms of commodity price upside. Now, this is where it gets quite neat because we are sometimes compared to an ETF. In the carbon world, there are a few carbon ETFs there, but you're investing in a carbon ETF, 1, because it's simple, but 2, you're dependent on price going up, right? I mean, the whole thing with that carbon ETF is that they're buying carbon credits at $20 and then they have to sell them at above $20 to generate some sort of return. There's value arbitrage. The nice thing about the royalty model is that we structure our deals at a conservative price, and then we assume that that price never goes up. So what I mean by that is in the example of that ETF where they buy at $20 and then they have to sell at above $20 to make some sort of return for the shareholder that owns the ETF. For us, it could be at $20 and then pricing can go down every single year and will still generate a return. That's partly how conservative we are as a group. But even though we have the upside there, there's downside protection. You kind of get best of both worlds in how we structure our deals.
And typically, how long are these deals structured for? 10 to 20 years?
Exactly. In the mining world, it's usually life of mine. So, you have a mine that has a 10-year mine life, but they've had a 10-year mine life for 50 years. They just keep on going. You have that mine life royalty for the most part. In carbon, it's a bit different because it's based on a crediting period. A project can't indefinitely issue credits. There's a finite amount of carbon potential in a project. And we can explain that later on if people are interested. But the point is, our royalty is usually tied to that crediting period. And that could be 10 years, it could be 15 years, it could be 20 years. What we do with our structuring, like I kind of mentioned earlier, Martin, we want to make sure that we have fairly quick paybacks. There's a deal that we'll talk about later on, this native state investment. It's a portfolio of forestry investments in the US. That deal has a relatively quick payback, I think 3 or 4 years, but it's a 20-year term. So we get our payback, and then arguably we have 16, 17 years of upside after the investment's been paid back.
Just to clarify on the Green Star model and the carbon credits, there are 2 types of carbon credits. There are voluntary and compliance carbon credits. Can you you're focused on the voluntary carbon credits, I believe, and can you just give a quick explanation of why on that market and just the differences between the 2 and maybe what current pricing of those credits is right now?
Sure, Martin, sure. So just to be specific, it's not that there are 2 different kinds of credits, they are 2 different kinds of markets, right? Because within those markets, you might have different kinds of credits. So generally, there are 2 carbon markets. One market is a compliance market, and there are multiple compliance markets. Compliance markets cover about a quarter of global emissions. The biggest one is in Europe. It's called the EU ETS, their emission trading scheme. We have one here in Canada. I'm in Canada, so we have one in Canada. The US has some in parts of the US. The point is, compliance markets mean that you have a regulator, typically a government, that would mandate large emitters to reduce their emissions. And they can do that either by paying a carbon tax or by buying a carbon credit. We have investments on projects like that. The other market is arguably the market most of us have heard about. This is the voluntary market. So these are companies that are voluntarily offsetting their emissions. You can argue, Martin, if they're voluntarily doing it, if they're being pressured by their larger shareholders, you have more generalist investors asking for it, you have more impact investors asking for it. So how voluntary is that? I would argue it. But the point is, there's no mandate, there's no regulator that's enforcing it, at least not right now. So they're voluntarily doing it. And think of every company out there, a Microsoft, a UPS, a Netflix. The aviation industry is a bit of a hybrid voluntary compliance, not to get too complicated, but any company you've heard of that has a net zero goal, well, they would be the ones that would be buying these voluntary offsets. It's one of the tools in the toolbox to hit net zero by 2050 or whatever their target is.
On the compliance side, obviously the government's regulated, and on the voluntary side, they're call it auditors or certification people who say that, hey, these are true carbon credits, and this is yes, this counts as a credit. Is that how that's regulated?
That's right, exactly, Martin. So similar structure, but one is a government and another one you would have different systems in place. You would have what we call registries, who are essentially the carbon police. They're the ones who come out with the protocols that explain, is a project eligible? How do you quantify the carbon? So they do all of that work. You have other groups that are involved called validation and verification bodies. They're independent to the registries, but they're doing all the audit work. So just like in securities, you have the SEC, and then you have KPMG that audits your financial reports. It's the same thing, just different groups, obviously.
STRR Royalties was here 13, 14 months ago. Can you just talk about what's happened over the last year or even 2 years? What are the notable milestones that you've achieved over the past while and their significance for STAR and Green Star?
Sure, Martin, sure. So over the last 14 months or so, we would have had four main announcements, four main transactions. The first and easily the biggest one, the most important one, would have been in December, just before the holiday break. That was this Cenovus strategic investment that we touched on in the overview. I mentioned a joint venture. Before that deal, we were a JV between STRR Royalties and Agnico Eagle. After that announcement, Green Star became a JV between them and Cenovus Energy. And hopefully it's obvious why that's important, right? It's a major endorsement of the business, of the team, of the portfolio, of the pipeline by a second natural resources company, one of that size. Cenovus took almost a year doing their diligence, so they did a lot of homework on understanding us. What the deal itself was, they bought $21 million worth of Green Star equity. That's 26% of Green Star. So for $21 million, they took about a quarter of the company. They own the same amount that Agnico owns. That's important for a couple of reasons. It valued Green Star at $82 million. And for Star and Star shareholders, it valued the ownership that STAR has at 46%, I mentioned, at $37.5 million. So the point is, we trade for much less. We actually trade for half, roughly, of that value that we own in Green Star. And Cenovus and Agnico, these are long-term strategic partners. They're going to co-invest with us in the future. We can access larger deals. But that would have been the biggest announcement, Martin. It took a year to get to it. In terms of the other announcements, we announced a new royalty. This is the one I just mentioned earlier. It's with a group called Native State, carbon royalty investment that we did a month ago, checked all the boxes, fit the mandate well. It's in the US. It's in prime timberland in the US, premium projects, 100% removal in the years 6 onwards. So that's what we were looking for. We invested in what is a portfolio itself. So even though it shows up as a dot on that map, it's actually going to be 4, 5, 6, 7 different dots. The first project within that portfolio is fully verified. It's issuing credits. It's issued credits to us, meaning that Green Star now has credits to sell. We're in the process of selling it. That's how we transition to free cash flow. Good deal, good economics. The other two to mention were optimization efforts. The first one was on the green side. We have a large regen ag investment. That's regenerative agriculture for everybody. I'm just going to shorten it to regen ag. Our regen ag deal, we optimized the structure of that deal, the alignment between the three parties there. What that means is that we had a good structure before, we have a better structure now. We converted our royalty from a proceeds sharing agreement to now a top line revenue sharing agreement. It's more robust. It's easier to explain to people. It's easier to calculate. We also extended the term. That was a 10-year term. It's now a 20-year term, and we had no extra investment to do that. So free upside for the future. On the mining side, we also optimized one of our investments. This was on the Copperstone stream. This is the project in Arizona. We optimized the stream because before, Martin, we had a large stream in the initial years, and then it stepped down over time. What we've done is we've flatlined it. We now have a 4% stream life of mine. And that's a good thing for a few reasons. It simplifies the structure. It smooths out the cash flow profile, which we want because public royalty companies typically trade on price to cash flow. It's easier to do that when you have consistent cash flow. And the thing that we really wanted was we wanted much more upside to the tail end, either for resource conversion or higher gold price, the things we talked about earlier. We now have a much bigger part of that than we would have with the step down. We also brought in money from that restructure. We brought in 4.5 million Canadian. Overall, a good example of how to improve your portfolio.
And I just want to highlight, you were saying that currently STAR Royalties is trading at half of its sort of value of its 46% of what Green Star has been valued at through the Cenovus investment. But that doesn't even include your gold royalties as well on it. So you're at half plus subtract out the gold royalties. Is that correct?
That's correct. And I have an entire value walkthrough to give you. It might make sense that I give it to you in a little bit because it's going to be dependent on things that I'm going to tell you before that. So I don't want this catch 22, but that's exactly right. Right now, you would be buying Star for 0.5%, 50%, I should say, on Green Star. You're doing better than what Cenovus did. So congratulations. And then you're getting an entire mining portfolio at no cost, which clearly has value. And I want to walk through why there is value there.
You put out your quarterly results today, and I don't want to dig into them too much, but just so people who look at your financial statements, because you own 46% of Green Star, I don't want to get too nerdy on the accounting, but how does that show up on your balance sheet? Is the money that Cenovus invested, does that appear as the cash line on your balance sheet, or is that just as under a general investment thing? And do revenues from Green Star appear as revenues for Star Royalty?
Okay, that's a good question. So don't nerd out too much on me, Martin, because I'm not an accountant. I'm a geologist by training. So the way it works, it's a bit complicated, and I'll be candid about it. The way it works is that when you look at the Star financial statements, what we have in Green Star is essentially an investment in a joint venture. So whether we're generating more revenue at Green Star in future years, which we will, or the value of what we own in Green Star goes up because we do an equity issuance at a higher price for Green Star, it all shows up in this one number. So it's not like the revenue at Green Star shows up as the revenue at Star. It shows up in our ownership, essentially in our book value at Green Star. And because there's this fair value adjustment on a quarterly basis, it gets complicated. This is honestly a bit of a challenge with carbon markets right now. But that's what happens. You will see these upticks and downticks, and well, carbon's gone up, so your whole portfolio is worth more. So that line and the Star financial statements goes up, and inversely the same thing if it were to go down. But we're very conservative in how we account for things, and we're doing that specifically to avoid these big swings up and down. We have an equity research background. I used to be in equity research. Half of our team used to be equity research. We're very mindful of how investors think of the story and how they look at these financial statements. We want to make it as easy as possible.
So why did you the focus on carbon credits on Green Star? Why did the company make that decision, especially given how the price of gold is doing right now? Is there do you have a motivation? Oh, maybe we should put a little more effort back into the gold market since gold is doing well, or that's your course, your path has been set towards the carbon credits?
Yes, yeah, great question. So look, on the gold point specifically, we're benefiting from that. We still have a gold portfolio and we are benefiting from that value gain. But I'll explain mining portfolio value later. Why Green Star? Why focus on this? I think the answers are pretty simple, Martin. The first one is that from what we're seeing, it is a much higher return business model. And us as capital allocators, we have to chase the higher return business model for our shareholders. It's logical. If you look at our green deals, we're targeting 20 to 40% after-tax returns compared to what you see on the mining side, assuming pricing flat, of course, for both comments. On the mining side, you would see 6 to 10% after tax as a target. Realistically, a lot of companies are getting low single digits, and arguably sometimes they're getting negative returns. So we're just getting much better returns. We're getting way more bang for our buck on the green side. The second point is that we're seeing generally a broader range of shareholder interest. Now, it fluctuates like everything else, everything's cyclical. But given the amount of growing impact investors and generalists that I talked about earlier, we're seeing that. Mining is a big industry, but there aren't that many investors. There aren't that many precious metals investors or funds that specifically invest in mining. It's a fairly niche thing when you think about it. Whereas this carbon, decarbonizing the economy, it's much broader. So it's maybe a bit more applicable to shareholders. Third point is the quality of the deals and the quantity of the deals. We are able to see better deals. These are just better quality opportunities, partly for the returns. There are many more deals out there, so we can be way more selective. And the counterparties are stronger. They're more reputable. They're more robust. We're dealing with better groups typically on the carbon side. And you can see based on the partners that I mentioned earlier, right? That translates to the fourth point. The fourth point is that it's just less competitive. We have 2 or 3 other groups in the carbon finance world, and they're all different from each other. They don't do what we do. Green Star is completely unique in how it approaches project funding. Versus the mining side, there are 20 precious metal royalty companies, private equity groups that do royalties. You're competing with a lot of different people for smaller returns. The fifth thing to mention, and the last one, is more of a strategic thing, Martin, in that I really do believe we're establishing a leadership position in funding the economy's decarbonization. So what do I mean by that? We have been carbonizing the economy since the Industrial Revolution. That's literally what that is, right? And that's been the biggest capital deployment exercise to date because it's been the economy. Decarbonizing that economy will be a much larger capital deployment exercise. Whether people are like it or not, it will cost a lot of money to do it, much more so than it's cost to get us to this point. So I say that just given this point, and this is not to be arrogant at all, but I'm a big fan of Franco-Nevada. They are the golden poster child in terms of owning the gold royalty space. Franco was an unheard of name 40 years ago, and now they are the go-to name. They're the 40 billion market cap juggernaut company, right? Thinking of parallels here, we're early in this game, but we've already established a good foundation. We want to be that safe, logical proxy for investors who want to own exposure to decarbonization. And I'll give you an example just before I finish my point. Yesterday, there was a very big announcement from the US federal government. The White House had this monumental announcement that related to carbon. What that was the release of these guidelines, mostly for the American private sector. And it was about how to use carbon offsets. How do you use these to hit your net zero goals? That announcement is going to generate a lot of demand for offsets, especially because a lot of companies have been waiting on the sidelines patiently and quietly for this kind of guidance to come out. The point I'm getting at is if you're an investor and you see that headline on Bloomberg or Financial Times and you think, wow, that's cool. How do I get exposure to this? How do I buy something like this? How do I buy into the thematic? I want Green Star to be the answer, and that's what we're positioning ourselves to be.
You mentioned that your model is unique to the other carbon streaming, carbon financiers. And without getting too much into the weeds, can you just sort of broad strokes on how are you different?
Sure. So, look, it's not necessarily a comparison to the other groups on who's better or not. But if you look at our structure, we've talked about the joint venture, that's unique. Let's not go and repeat that. I think that's a given. If you look at the portfolio, our investments are in the US, in Canada. These are what I call tier 1 jurisdictions. We will continue to invest in the US and in Canada. Eventually, we'll look at other tier 1 jurisdictions, whether that's France, UK, Germany, Australia. We will not invest in higher risk jurisdictions. And this is not a comment, Martin, on the environmental quality of those projects. It's a comment strictly on the geopolitical risk. We all know it well from mining. Those are tough jurisdictions to invest in. I don't want to do it here. That is a very different differentiator compared to our peers who are invested there. And to be honest, good for them because they have to invest there. Those projects have to get funded. I don't want that. I want to fund it where our investors, who are typically North American investors or British or French investors, they want to invest in something that they're familiar with, that they're comfortable with. Well, I'd rather invest in Colorado than the Congo because of that familiarity. So that's obviously one point. Another point would be the types of projects. Like I said, we're funding agriculture, improved forest management. Not that our peers are not doing it, but we are funding particular projects that seem to be much more in demand than some of our peers and what they're funding. And the way we're structuring it as well, these are royalties where we can take delivery of the credit or get the cash from the sale of the credit because our large carbon development partners can sell those credits on our behalf. Our peers typically take delivery of the credits and have to sell that. And that's fine, but it's extra work. It's more complicated. You're competing with other groups to sell credits. We don't necessarily want to do that ourselves in-house. I'd rather keep the G&A low and rely on the experts to do it. So those are just some examples of how we compare, I think, favorably to our peers.
In the carbon credit market, is there like an exchange where you just look up the price of it and you say, I've got 1 million credits to sell, and you wait for someone to hit your to take your offer there? Or is it a negotiated kind of over the counter kind of a situation where you hire an agent to shop it around, or you know that Microsoft got to get carbon positive by whatever 2050 or 2040, whenever it is, so you give them a phone call and see if they're interested in your credits? How does that market work?
It's a bit of both, Martin, but generally it's more the latter in that it's more over the counter. And this is a complexity of carbon, to be candid. It is typically a fairly illiquid and opaque market. And I compare it all the time to carbon, pardon me, not carbon, to diamonds. They're both carbon made, the diamonds. I know the diamond industry quite well. Diamonds, each 1 carat, have very different values. Why is this one $10,000 and this one's $1,000, even though they're both 1 carat? Well, for the inherent characteristics of those diamonds, just like carbon credits. And those trade in a very illiquid way, right? You can't just go on some market and see what's the price for 1 carat. Similar to carbon credits. Now, there are markets in place. You can have those, and that is coming more online. Even the banks are setting up carbon portals for emitters. And these are larger groups, not necessarily you or I as individual buyers. So all those systems, all that infrastructure is coming to place, but right now it's more what you said. You work with a carbon developer, marketer, broker, direct off-taker. You negotiate a price that you think is reasonable, and then that's how you transact.
What is the development and growth plan for the Green Star over the coming years? Look for more projects and invest in them. Is that it, or is there what's? I'm sure it's a little more nuanced than that.
It is that, and it's more nuanced than that. But there are 2 parts. There's the capital raising component, and then there's the capital deploying component, as I like to put it. So let me give you the capital raising angle first. In the nearer term, it's a function of how we want to access capital, right? How do we raise capital in the most effective, the most efficient, most cost-effective way to do it? So Green Star, we're always looking at private capital raising opportunities. We've done it successfully a couple of times already. That's how we brought in Agnico. It's how we brought on Cenovus. But the point is, we like to prioritize larger, more sophisticated investors. If we can find the right partners there, then we look for the right fit. And if we can find the right fit, which is something that we're always working on, we're working on that right now, well, then we can raise some meaningful capital with those kinds of groups in the next 6 to 12 months. And then that capital gets deployed immediately into the pipeline that we've been building up. In parallel to that, and maybe even an alternative to that, we can look at public capital raising opportunities. So Green Star can go public either through an IPO or through an RTO. If we do an IPO, we did that with Star. We're familiar with how to do it. So we can do a traditional IPO pathway. We could do an RTO into Star, which involves the mining portfolio. I'm going to get to that in 1 second. I wouldn't want to RTO into an unknown SPAC or capital pool company. I don't like that. I don't like the governance of it. So we could do either way. The question that we always have, how we think of it internally, is you can likely access more capital and maybe even lower cost of capital publicly if you do it sooner as the first step. But you might not have the critical mass in the portfolio either once you're public, because you need the private capital to build up that portfolio and then be that go-to name once you're public. So anyways, what I'm saying is internally, we're always contemplating, do we raise capital privately first and then go public? Or do we look at going public first because that's the smarter thing to do? The other thing is, well, we can look at the mining portfolio. The mining portfolio is a tool in the toolbox that we can monetize to build out Green Star. And I want to talk about that separately because that's an important point, and we get that question all the time from our investors. Longer term, easy answers that you redeploy the cash flow from your portfolio into the pipeline. You further expand and de-risk the portfolio that way. In terms of a deployment perspective, the types of deals that we're doing, I kind of talked about that earlier, Martin, and that we want to diversify, we want to de-risk, we don't want to diversify, as I like to say. And I say that, it sounds obvious, but you can't underestimate the amount of companies that grow for the sake of growth, right? So we talked about the geography, where we're focused. We're highly focused on tier one jurisdictions. That's always going to be the case. Project type, I talked about it. If it's technically proven and if it's financially robust and viable, we're going to look at it. In terms of investment size, I like the snack bracket of 5 million US with expansion potential. If you can do a $5 million deal and then make that a 10 million or $20 million deal, and we've done that in the past, I think that's great. We can obviously access much larger deals, especially if Synovus and or Agnico co-invest with us. Market type, Martin, you had asked about compliance versus voluntary. We are more voluntary today, although we do have compliance exposure. I would like more compliance exposure in the future once compliance has fully established itself, especially here in Canada. It's happening, but it's not there yet. Offset type, again, we talked about removal and avoidance. They're both important. You need both of them. You can't pick one of them, but we are prioritizing removal. We'll have more exposure to removal going forward. And then the maybe last point I'll make, it's more general, but it's important for the strategy of the portfolio. Our portfolio today at Green Star is 95% carbon. Eventually, I would like that to be a bit more balanced, and that maybe in the coming years, I don't mean next year or even in 2 years from now, maybe in 5 years, 10 years from now, I would like that to be more 50% carbon, 50% clean tech, because I want to have exposure to everything and that whole thematic of decarbonization. And that isn't just carbon. Carbon credits, that's one tool. It's not the only tool. I want exposure to all the tools in the tool shed.
Can you clarify that a bit? When you say alt, would that be just sort of investment in equity of clean tech companies, or is there another kind of credit or royalty structure for clean tech? I'm not sure what you're exactly referring to.
Sure.
In investing in clean tech.
Not necessarily equity. That moves away from the royalty model. It's more royalty on the underlying business itself. So we have an example. The example in our portfolio is a company called MobiSmart. MobiSmart, local business, they're based here in Toronto. They manufacture mobile, trailerized, off-grid solar and wind systems. So what I'm saying is they have renewable tech that displaces a diesel generator, whether that's at a mine camp or at a military base or at a music venue. That's playing the decarbonization theme because it's avoiding emissions from a diesel generator, but there's no carbon credit associated to it, at least not yet. Maybe there will be in the future. So the royalty there, it's a royalty, it's a 2.5% royalty on the business. As this business manufactures more of this for the telecom industry or the mining industry or the oil and gas industry or the military, then we get a royalty on those units themselves. So we're still playing the same game, just in a slightly different way. And I want exposure to that as well as just revenue from carbon offsets.
So it's a funding mechanism for growing companies where they take on some funds and then they repay the loan or the royalty as a percentage of revenues as a non-dilutive, non-debt funding mechanism for their business.
It's exactly that. If you're a small group, you can either rely on equity, and usually your cost of equity capital is prohibitive. And if you're private, you might not even be able to do that. Or you rely on debt. Debt is sometimes high cost, a lot of balance sheet covenants to deal with, and it's higher risk as well. If you don't pay off that debt, well, then what happens, right? It's like if you don't pay off your mortgage, you don't really own the house anymore. Whereas the royalty model, this is resonating with all of these counterparties because it's aligned. It's kind of like having a shareholder without the dilution, like you said. So it's a non-dilutive way to play where we share in the upside together and we share in the downside together. But that's why we have to structure these deals where we're protected in the downside. It seems to be resonating well, and I think we're getting a lot of business because of it.
what are you going to do with the mining royalty portfolio? Are you just going to use that as a cash cow then to fund your greener initiatives, or wait for them to sort of maximize value and then sell them off, or what are your plans for the mining royalty portfolio?
Yep, for sure, Mark. I'm sure a lot of investors are quite keen to hear about this. So there's a lot to talk about here. Let's talk about the plan, and then let's talk about the value for that plan, right? The plan for the portfolio, the general answer at the beginning, I'm going to say, is that we're a royalty company, which means that we're essentially a portfolio management company, meaning that we are portfolio managers, meaning that our job is to optimize the portfolio, right? I've talked about the mining portfolio kind of around this discussion so far. I've mentioned that it's non-core and that our capital allocation is being prioritized to Green Star and its build out for hopefully all the reasons that are very clear to the audience now. Let me just set the stage in that us as a team, as mining investors, professional mining investors, we look at mining royalties and or mining royalty portfolios that are up for sale all the time. That's our job. And most of those portfolios are either located in challenging jurisdictions, they have no defined resource or no technical reports, they have no infrastructure at site, or they've never had historic production. So trust me when I say our portfolio is an attractive portfolio because we have 100% tier one jurisdictional exposure, given that this is Canada, USA, Australia. It doesn't get better than that. Our investments are on advanced assets. They're not perfect. We'll talk about that, but these are advanced assets. We have significant weight in our mining portfolio towards gold. There are a lot of portfolios out there that have gold, but then they have iron ore, and they have all sorts of elements on the periodic table that most people have never even heard of. We have a gold-dominated portfolio, and it's a portfolio that generates revenue and has revenue growth. So what I'm getting at is that there aren't many portfolios out there available like this, meaning that we get inbound interest for a portfolio like this because we're vocal that our focus is on the green business. I can only say so much, Martin, as you can appreciate, and hopefully the audience, you can appreciate this as much. I can only say so much, but it's fair to say that we're not married to the mining portfolio. We would consider opportunities of monetizing that portfolio either in parts and then eventually in full or in full right away. Consideration of monetizing it sooner or later comes down to potential M&A and funding solutions at our gold assets at Copperstone and at Elk Gold. This is Arizona and British Columbia. If we can have an M&A solution there or a funding solution there that raises the value of that asset, well, then that obviously raises the sale value of our portfolio. What we won't do, to be crystal clear, is we will not sell the mining portfolio at 0.5 or 0.4 times book value. We could do that today. Right now, I can guarantee you we could do it. But I think that would be a huge disservice to our shareholders, of which we are shareholders, and that would not be the right thing to do. So we're under no pressure to sell it, which is a good position to be in. We have good financial health. We have no financial constraints. We will look to maximize value, like you said, Martin, at the right time. But yes, it is fair to say, sooner or later, we will be looking at monetizing this mining portfolio because the goal is to purely focus on Green Star.
The mining portfolio, with the rise in gold prices and that you've kind of got a one-to-one relationship with the gold stream or predominantly gold stream in your portfolio, how is the portfolio value done? And if I'm correct, a lot of your projects are earlier, like they're not all producing yet. You still have some inflection points to hit. So there's a lot of value creation yet to come, I would think.
Yes, correct. I think you've answered part of it, Martin, right there. So, when I get asked, how do we look at value for the mining portfolio? I would argue not only have we maintained it, but I would argue that we fundamentally gained value. It doesn't show up at all in the share price, but just fundamentally, let's go through the logic. You touched on the first one. The first one is gold price appreciation. Gold is up about $600 US an ounce since we've made these acquisitions. That's a 33% gain, plus or minus. The royalties are obviously worth more because of that, right? They're arguably worth 33% more just from a commodity price input perspective. The second point is from a resource expansion perspective. If you look at Copperstone, that mine, it's a historic mine, that mine now, that project has expanded its total contained gold ounces in the ground by 23%. If you look at it at Elk Gold, this is the mine in British Columbia, 32% since we've acquired those respective investments. So you can easily derive, based on the resources at those projects and what we have as a stream or what we have as a royalty, you could derive a royalty equivalent interest of 40,000 ounces of gold that are attributable to STAR. At a gold price of 23.50 roughly right now, that's 87 million US or 117 million Canadian in undiscounted gold revenue potential. It's a very rudimentary way of calculating value. I would argue that's not the best way to do it, but it is value nonetheless. So objectively speaking, I think it's fair to say you can justify why one would think the royalties and the assets themselves have improved in value. So here's the flip argument. Without a doubt, what has hurt us and what's reflecting the share price is that the operators of these assets have missed expectations. For one reason or another, they've missed expectations. And those missed expectations have delayed what we've expected as timing for royalty cash flow. So let's use Copperstone as the example. Copperstone, if you did a net present value calculation today in Excel, that NPV calculation would give you a higher NPV than if you did the NPV at acquisition because of the gold price, because of the resource expansion, partly because of this restructuring. But that said, Copperstone was expected to be producing by now when we made the investment in late 2020. It's not. Saber Gold, the operator, has missed that target for one reason or another, like I said. But the point is that they have missed that target, and that has caused us to miss our own revenue expectation. And that miss in target has a disproportional penalty to us, right? Even if the asset is still worth as much as it was before, the fact that we haven't met this target, which unfortunately is outside of our control, it's the operators, that has had a major impact on our share price. So how do we rectify it? We work closely with the operators. We do that all the time. We talk to some of these operators multiple times a week on M&A opportunities, on funding solutions. Sometimes it's one and the same, sometimes it's technically different, but we're trying to unlock that next step, that value. I believe the mining portfolio would instantly re-rate if our gold assets were in the hands of a financially and operationally more capable operator. But what I can say is that based on what we do know, I think it's fair to say that we could monetize our mining portfolio for more than what our market cap is today. So there is value there. It's just unfortunately not showing up.
Your projects have been delayed a bit on the gold side or on the mining side. Why should investors be buying today? Why today? Why not maybe wait until they pour first gold, call it?
Sure. Look, there's some pretty logical reasons, I would say. The first one is just how severely undervalued we are from a sum of parts valuation. So I'm going to give you a lot of numbers, Martin, but I'll go slowly. STAR owns 46% of Green Star. What that means is that we own 25 million shares of Green Star that are valued at $1.50. That is the $37.5 million I mentioned earlier. That works out to 50 cents a share at STAR, right? And you can defend that value because it's an independent valuation. It was first done by Agnico. It was then done by Cenovus. If you know anything about 50 billion market cap companies, and I know it, I come from that world, these are businesses that are good at making money and they're good at not paying full value. So you've got that consideration. On the mining side, we've got a book value of just under 21 million US, so call it 28 million Canadian. That's 36 cents a share at STAR. If you combine both of them, you got 86 cents a share now. So it's 3.5 times higher than where we are today. I haven't looked today, but we're probably in that 25-cent range. So in other words, we're trading at 0.29 times compared to our junior royalty peers, not the big guys, but the small guys that are at 0.68 times. Now, to be fair, a discount is merited for what you just said, Martin. There have been delays. We're also a special situation. We were one company that became two related but separate companies, and then eventually we became one company again, or pardon me, I should say we will become one company again. So I don't think the quantum of the discount is merited. You could even argue that maybe it shouldn't be 86 cents, it should be 50 cents a share. That's a double as to where we are today. That's why you want to buy today, because you have that upside. Now, how do we erode the discount? Now it's talking about the catalyst. So at Green Star, this native state deal we did a month ago, we received credits. We're going to sell those credits. We're going to receive more credits likely later this year. We have more projects under that royalty structure that will come online. That's going to generate more news flow this year, more credits for us to sell, more value accretion. On the regenerative agriculture side, all sorts of updates that are going to be coming out over the coming months. There's a validation that happens. There's a registry. There's a verification that happens. These are all part of a registration process. First credits next year, further capital raising, further capital deploying opportunities there. On the STAR side, you get advancement with the gold assets. Like I said, if there's any M&A opportunities or funding opportunities and you own now, you get the re-rate. If you buy it after, you miss the re-rate, right? We could look at monetizing the mining portfolio, which is something that we're considering, either in part or in full, like I said, at the right price and at the right time. So everything I'm pointing to is hopefully explaining how to value the stock and the catalyst to re-rate the stock. But I'm just going to make one final generic point here to drive it home. There's an opportunity to buy STAR and get Green Star at half off, like I said, 50% off than what Cenovus paid. Plus, you get the mining portfolio at zero cost that will obviously get monetized for more than zero cost, right? So you buy in before the story gets cleaned up, more concise, more marketable from a carbon perspective. And if you follow carbon markets, including that big announcement from the US government yesterday, you would be aware that there is a massive amount of demand that's coming online in the coming years. I can give you all sorts of examples. One of them is the aviation industry. They have a compliance market. They could easily buy out the entire voluntary carbon market supply. That's one industry. You put in fast fashion on top of that, that has an even bigger carbon footprint to aviation. You can get these pretty exponential projections. So if you want to own something that can make a lot of money under this net zero theme, we've already started positioning ourselves for that. We've put in the foundation. You can get it for very cheap at 25 cents. And then once we become that quality leader, that go-to name that investors want to own, you get the re-rate because you bought it in right now. Buy it now and then get the gain later.
Alex, I have been hogging the puck on the questions here, and so I thank the audience for their patience. I hope they've added some value here. So I'm going to switch over to audience questions here. I got an email question here, which I will read out. Thank you. What is the risk that farmers will abandon re-ag project in the future, deeming carbon offset as worthless, cutting off expected future cash flow? Is this a real risk, especially when you're looking at a 20-year horizon on a farmer and they may be forced to start using chemicals or other fertilizers again? Just for a farmer, 20 years is a long time and things change.
Yeah, okay. Great question. Thank you, Martin, and thank you for whoever asked the question. So there are two parts of this question here. The first one is what happens if carbon markets are not around in 20 years? And that's a bit separate to the second part of the question. So I hope, I'm not sure when the question came in, but I hope that our whole discussion on carbon markets clearly point that carbon markets will not only be here in 20 years, but they're going to be much bigger in 20 years because these carbon markets have to be here for these companies to hit these publicly stated net zero goals. So let's just move away from that comment and that I think it's fair to say carbon markets will be here. They've been here for 20 years. They're going to be here for well more than 20 years going forward. Let's talk about the farmer specifically. One key point, and it's a bit of a correction to the question here, these farmers are not replacing their traditional fertilizer, what we call NPK fertilizer. They're not replacing that with a probiotic fertilizer. They're complementing it with a probiotic fertilizer. So these growers are using a fertilizer, maybe slightly less traditional fertilizer, and then they're also incorporating a probiotic fertilizer. So it's not a displacement or replacement of it. It's a complement to it. And I say that because it's important for the point that it's not like they've cut it out and then we'll go back to it. The other thing to keep in mind is that a lot of the growers that are coming into the program, it's not necessarily for the carbon credit itself. That's a byproduct, which we care about and they care about, but it's not the sole focus. What they're trying to do is rejuvenate their soil. And I'll give you a real example. There's a grower in this program that enrolled. He's in Colorado. I think he's north of Denver. This is a grower that had been doing heavy tillage, heavy nitrogen fertilizer use for years and years and arguably decades. And they've essentially depleted their soil of its health. And they're now at a point where they need to change that. They have to go to Regen Ag because they have to replenish that soil health, or else there won't be soil. There will be dirt. There's no farm anymore. They have 6 years to figure it out, and they can't afford it. So they want to join a program like this because there's a probiotic fertilizer that helps rebuild that soil health, gets a better crop yield, and then also sequesters the carbon and gets the carbon credit. So the point is they're doing it because they have to. That cost of the probiotic fertilizer is covered. they're getting a yield increase on their crop. So that's a win right away, and it should be happening all the time as they use this probiotic fertilizer. It's going to take decades to saturate the soil. So it's not like in 20 years they figured it out. They've destroyed the soil over 120 years. They're not going to fix it in 20 years. So that's why they're doing it. Plus, they get the carbon benefit on top of it. Hopefully, that addresses the question.
I'd just like to add to a bit. What if, and I know this is absurd, but let's say they decide to turn it into a shopping mall, and then the carbon isn't happening anymore. Does somebody have to repay someone else if, for whatever reason, something goes wrong with the project?
Yes, that's a good question. So what we're talking about here, we call it attrition, right? You have 100 growers, and then you lose 2 or 3 growers, and then you bring 2 or 3 growers back in, and then you add another 50 growers. So it's a dynamic system. You're not going to have the exact same growers now versus in 20 years from now. It's a fluid situation. What happens in a case like that, and really in any sort of carbon loss or carbon reversal, as we call it, there's an insurance mechanism that's built into these kinds of programs. So, Martin, I mentioned a registry earlier. The registry that we're dealing with for this program is called Vera. Vera is the biggest registry out there. A Vera would have what we call a buffer pool mechanism, where we're contributing 26 to 30% of our credits every single year. Think of it like a stockpile. If you're using a mining example, you're stockpiling credits in the situation where you might lose a grower. If there's no loss, there's no grower that builds a mall in the middle of nowhere, Kansas, well, then those credits just come back into the program. If you lose that one grower because they built that mall, and then the carbon buildup that's happened, well, you've already accounted for it with the buffer pool mechanism. The insurance protection covers that loss in that case.
How has farmer enrollment been in Regen Ag? When do you expect the program to be fully enrolled?
So the enrollment has been progressing well. It actually accelerated from our initial expectations when we made this investment. We had more enrollments than we were expecting, which is a good situation to be in. But what we then realized, and this is part of the whole restructuring comment that I made, we realized that we want to be very selective on who we bring in here, right? We want the most forward-thinking, adaptive farmers in the program that have the best soil, that can sequester the most carbon, basically the best longevity for these farmers, right? The most aligned, incentivized, motivated farmers in this program. And not that we weren't doing that before, but we're extremely cautious on that going forward. In terms of where we are right now, when we announced the investment, we were targeting 320,000 acres. And then we were getting a lot of enrollments. So we said, okay, let's expand that to now go to 1.32 million acres. We knew we weren't going to get a 1.32 anytime soon, but we wanted that headroom so that we didn't lose any momentum. We've surpassed the 320,000 acres. We don't have the exact number right now because it's in the process of getting figured out, but and the 300,000 to 400,000 acres is what we would be looking at right now. In terms of when we expect it, it's a projection. So I caveat that. Our internal models assume that we would be fully ramped up by 2027. It could obviously happen sooner. It could happen later than that as well. But we're assuming over the next few years, we get to that full enrollment of 1.32. Once we get to that, if the program is working as we expect, there's a lot more than 1.32 million acres out there. So we will look to possibly expand a program like this, or maybe do a similar program to this. And the types of opportunities that we might do in the future, you could see us do something that looks like this, but is not this specifically.
What are the conditions required or needed for a Green Star IPO? Or I guess some other sort of transaction, let's say.
Sure. Well, it obviously depends on what we're talking about, right? Between IPO and RTO, let's talk IPO first. If we wanted to IPO, we would want a meaningful enough market cap. Nobody wants to go public and have a 20 million market cap, right? That's just the reality of it. So we want to have critical mass, not only in terms of our market cap, but our portfolio as well. So to go public, I'd like to have a few $100 million market cap. If I could choose that, for us to do that, we would have to raise capital privately first to then build up the portfolio. Like I said, we diversify it, we de-risk it, we accrete NAV or value in our portfolio. That's how we target a larger IPO. If we look at an RTO, that could arguably happen sooner, because if we have an opportunity to monetize the mining portfolio, whether that's going to be in 6 months from now, 12 months, 18 months, whatever it is, well, that might be a platform where we now have a capitalized vehicle that has money whether it's cash or equity, and whatever it is, or combination of the two from whoever are part of our portfolio, and the 46% ownership of Green Star. So that's a logical pathway where we put them together. As much as we all want to know, this is something that we spend every day on. I guarantee you, we think about this all the time. How does Green Star get to the next stage? We're working on it right now. There isn't a predetermined path yet. We're going to go down the path that makes the most sense for the companies and for the shareholders, of which we are large ones. So please stay tuned. You can expect some updates in the coming months as we make our progress, but we want to do this correctly. We don't want to do it quickly and it's rushed. We want to make sure that there's a vehicle here that's going to be here for the long term, and we can get that 40-year horizon like a Franco-Nevada had.
If carbon credits are so attractive, why is there not more competition for these high returns?
There is competition. It's just not coming from traditional royalty and streaming companies. It's coming from bank debt, and it's coming from very large energy companies that are writing checks. So we talked about equity, debt, and royalties. The royalty model has not been a well-known funding mechanism because we essentially introduced it 4 years ago or so. We did our first deal in early 2020. So it wasn't known by carbon developers that you can fund a project like that. Very well known in mining and oil and gas. And the irony, Martin, is that royalties come from medieval times. So it started on farming in Europe, medieval days. We're just applying it now in modern days with carbon. So there is competition, just in a slightly different way. When we look at our opportunities, we're competing with very large energy companies that are also looking to access credits. We're competing with very large tech companies. It's no secret that Microsoft and Meta and Apple are all doing these kinds of investments as well. They're very difficult to deal with, and I don't say that in a non-complimentary way. I mean that they're just very large companies that need to do a serious amount of diligence on investments, which we can do much more effectively because that's our business. We're not Microsoft that does everything plus this. We do just this. So we're more rapid. I think we're an easier partner to have, and it's been proving itself out with the investments that we've been making. So there is competition. There will be competition going forward. We're obviously not going to be the only people doing it. This is important why we're putting in exclusivity agreements with some of our counterparties. It's why we structured the deals with Agnico and Cenovus the way we have, so that we have this now and not somebody who's trying to do that in 10 years from now. We've already done it.
Well, and it's still such a young market compared to the metals royalty streaming business. And that's why 20 years ago, everyone had such fatter margins. And as more players have entered the gold and metals streaming business, things have gotten tighter. So I would think that part of it is just the age of this sector of the industry. It's not as mature, and there's more opportunities and probably more risk as well in some ways too.
It's a great point, Martin. And look, I keep using my Franco comparison just because of my mining background, but it's like somebody saying to Franco 40 years ago on what would have been Zoom back then, which was just in person, they would have said, well, are you really going to be the only one there? And the answer was no. Look what happened. You had Silver Wheaton, which became Wheaton Precious Metals. You have Royal Gold. You have all these peers of theirs that all came out, all have done well, and they were all nothing companies and then became multi-$10 billion companies. So I would imagine others will come to be, and that's perfectly fine. We're just a head start of everybody else.
What is your plan for selling the native state credits? Do you expect to sell them in 2024?
Yes. So look, that's something that we're actively doing. We've spent probably a part of our day every single day for a long time thinking about how we want to monetize these offsets. We're in the process of doing that right now. So not much more that I can say in that we are looking to monetize them. We're in the process of marketing them. We will look to sell them this year. And then if all goes according to plan, we would have more credits coming in later this year. And then we will look to sell them at that time. And something to know for you, Martin, and for our audience as well, you should be aware, there's seasonality when it comes to offset marketing. Q4 is a very good time to be marketing. We want to do it now just to be ahead, and we'll sell more in Q4. But Q4 is a very good time because you have all of the emitters that are looking to do their year-end reporting, their year-end accounting. They typically are highly active at that time. We just want to be a step above. So yes, we should see credit sales this year.
All right. And in a different question, but that dovetails nicely, please speak to the approximate pricing Green Star expects to receive for its credits and whether the CBL nature-based global emissions offset index that some investors follow is an accurate proxy for your pricing?
Okay, so that's a great question. I wouldn't say it's an accurate proxy because it's an average, right? I mean, that's essentially what it is. It's like saying what's the average car price? Well, you're including everything from the Honda Civic to the Rolls Royce and the Ferrari in there, right? And we're more on the upper end than the lower end with our credits. We've disclosed it before. In terms of a native state opportunity, there are two types of credits coming out of that investment. The avoidance credits, which are more plentiful at the beginning, and they become all removal. The avoidance credits, our sense is that we could get $13 to $15 US per credit. That's reasonable, that's achievable. On the removal side, those credits sell for more than $20 a ton. And obviously these prices are going to be, I would imagine, significantly more in the future, but that's what we expect today. Mid-teens avoidance, at least $20, if not more, on the removal side right now.
How certain are you that Verra will approve the registration of your regenerative agriculture carbon credits under terms that are favorable for Green Star? Is registration still on track for this summer?
Yes. So let me answer the first part because there are two questions in there. We are confident. Nobody's going to say 100% confidence because nobody can do that. We can't predict the future, but we are confident. We're working with the best carbon developer in North America who's done 400 of these projects. So there's confidence that we have a technical group in place externally and, of course, internally to get this done properly. In terms of the timing, our expectation, and again, this has been mentioned in our news releases, our expectation is that we would get through the validation phase by the end of the summer, and then we would move into the verification phase at late summer, early fall, and that would go into next year. So we're still on track with what we've been disclosing for the last few months on a registration perspective, with issuance likely mid next year and then instant payment to us on the royalty because we have a pre-sale on those credits. In a situation where something were to happen to Verra, this is a bit of a worst case scenario, but I do get asked this question sometimes. Well, we have alternatives. We can look at different registries. We can also look at off-registry opportunities. We've actually been approached by large agri-food businesses that have said, could you sell these credits to us outside of Verra? Follow the rules of Verra, but actually don't do it on Verra. We can pay twice as much as what these credits are selling for. I just mentioned $20, Martin, on removal. Some people might be willing to pay $40 a ton for this, because if you're an agri-food business, whether you're a Cargill or a Nestle or whoever, how do you hit net zero but having access to things like this? And you might not want to buy them as an offset. You might want to buy them as an inset. So the point is, we have alternating pathways. If for some reason it doesn't work out with Verra, although we are confident that it would, then we would just go and have this developed for scope 3 intervention, carbon inset opportunity for the agri-food business. And we may even make more money doing that, to be honest. So
question here regarding Altius Renewable Royalties business model, and would Green Star in the future consider funding new solar and wind projects via royalty investments? I guess that's going back to your potential clean tech investments. Would you go on the generation side or more technology focused or what?
A bit of both. I wouldn't say that we've been overly focused on what Altius is doing. They're a good business, and I'll be sitting on a panel with them, I think, in a few weeks from now. So they do what they do well. That's not necessarily what we're focused on. It technically falls under the decarbonization, clean tech theme that I mentioned. So yes, could you see us do something like that? Possibly. Have not spent time looking at that right now. I would also want to target higher returns. My sense is that might be more of a debt structuring return where they might be, and I'm not speaking for Altius at all, by the way, but those might be more in the single-digit return territory where we want to get something that has more wealth creation, and we're seeing that with the clean tech opportunities that we have. So it could be a wide range. It could be renewable. It could be direct air capture. It could be a part of a biochar, biological charcoal project. There's a wide range of what clean tech means. It could be battery recycling for all we know. So for that, we have to figure out what we want to focus on. But I don't see us being a direct competitor to Altius.
They would love to hear more context on the recent carbon credit deal.
Okay, well, I assume that's the native state deal. And I'm not sure what more I could say. I'd love to talk about it for longer, obviously, but this is the native state deal. The native state deal would have been worked on for many months, and we were very thoughtful on what the next deal should be on the back of a Cenovus investment. Cenovus didn't co-invest in this deal, neither did Agnico, but something that all of our investors and potential shareholders should consider is that any deal that Green Star does is by nature signed off by us, Agnico and Cenovus. So Green Star did the deal. It's Green Star Capital. Arguably, it's Agnico and Cenovus Capital originally because we raised that capital through them. But the three of us have signed off on the diligence and the deal itself. I think that's an important part because some people might not remember that they're involved in this. We're all involved. We're jointly making this decision. So it's a deal that we have been working for a long time. The first investment in that portfolio is in Arkansas. I would imagine most of our investments will be in Arkansas. They might be in neighboring states, whether that's Missouri or Mississippi or Louisiana, but mostly in Arkansas. Like I said, this is prime timberland. It doesn't get better than that. And I'll give you a real example in terms of the project that we've invested in. It's called ACR 783. You can go on the ACR registry website. You can look up everything you want about the project. It's all publicly available. That's something I think carbon does better than mining, to be honest. But what you'll see there is that this counterparty, not the developer, native state, but the actual landowner, S&J Taylor, they are a professional timber harvesting company. It's a lumber company, and they are converting to IFM with the capital that we're providing them. So it doesn't get more additional than that or more robust in that. This is a harvesting company that's implementing this to generate carbon revenue on their project. In terms of the other projects that would be coming online, there's another 60,000 acres that we'll be funding as part of this $5.6 million investment. These are all similar types of landowners that have been wanting to join the carbon markets. They want participation in carbon upside. They haven't been able to do it because they've been relatively small compared to the industrial size people that are in the tens of thousands of acres. These are more in the thousands of acres, which itself is massive. But they've typically been ignored in the past because they haven't had that kind of size. If you aggregate them, which is what's happening in the 60,000 acres, well, now you can generate some fairly sizable projects. So that's what it looks like. In terms of economics, I didn't touch on that, but 20-year term, we're expecting to get 75% of the credits, roughly 1 million credits over the 20 years. We're expecting 75% of those in the first 5 years or so. So you can imagine why we're getting a good payback upfront and we're getting the kind of return that we're getting. So I hope that gives some guidance based on the question. If that question came through the Q&A chat, please ask more if you want to know. But there's a lot of information on the website. There's a lot of information on the news release, and our team's always available to talk about that deal if there's interest in it further.
Oh, good. We get an accounting question here. Is there a time when you will recognize income from Green Star on STRR Royalties book at a rate of 46%?
Yes, in the way that we talked about it, and that it's not going to show up as a revenue line item. It's going to show up as this ownership in the joint venture. So if revenue is being recognized at Green Star, that will inflate our value for what we own at the STAR level. I'll give you a different example. We're going to make an investment in something like a native state. To the previous question, I mentioned that was a $5.6 million US investment. It's obviously worth more than 5.6 million because we need to generate a return, right? Nobody buys something for that worth. So that investment, although we're deploying 5.6 million US to it, is arguably worth much more. You can do the math and you can say it's worth twice as much. So how do we recognize that? When you look at the joint venture line item, you would see that value accretion gets captured there. I'll give you the perfect example. When we did the Agnico deal, we put assets that we had contributed maybe $5 million towards, and that got recognized at $25 million. That's where it shows up in the financial statement. When we did the deal with Cenovus, that said, oh, well, those $25 million worth of shares that you have, they're now worth $37.5 million. Here's a big boost. That's what happened when we did our year end, right? Because that Cenovus deal happened in December. That's how it gets recognized. It's not ideal from an accounting perspective. It gets a lot cleaner when there's one business, there's Green Star, and then there's a mining business, either a STAR or there's no mining portfolio. It gets a lot easier at that point. Right now, we're in this adolescent phase where we're doing the accounting the way it has to be done as per our auditors at KPMG, and then it will be simpler in the future. One hopes.
And just to clarify and simplify that, 46% of Green Star's revenue will not appear on STRR Royalties revenues. They don't appear there as revenues. They're just very independent. That all that value falls into the investment line on the balance sheet, and then some income statement adjustments as well.
That's right, Martin. So whatever value gained from a fair value calculation at Green Star, that times 46% is what shows up for Star.
The question here is the potential of a second term Trump impacting Green Star's allocations decisions in any degree? And I'll add to that is there has been some, let's call it an ESG backlash with certain states and regions and political leaders. The Trump question, but generally this ESG backlash or just whatever political machinations, is that how does that potentially affect you and your investment decisions?
Look, candidly, it could slow down the carbon space. I wouldn't say it necessarily changes our investment philosophy, our strategy. We built it to make sure that it can weather a president over another. Keep in mind, some of our investments were when there was Trump in office, before Biden was in office. So that's one consideration. Something that we have to always keep in mind, though, the voluntary market and Trump don't correlate. If the U.S. had a compliance market at the federal level, that's where it starts changing things. But if there's a local compliance market in California, doesn't make a difference. If there's a voluntary market globally, of which our investments are in the US, doesn't really make a difference. Where a Trump could slow things down is, for example, if you're following the news with the SEC, the SEC is looking to put in disclosure, and they're in the process of doing it, they've already done part of it. They're putting all sorts of climate-related disclosures there, which honestly is a good thing. I know people take this as a political way, but if I'm an investor, I want to know what my at-risk capital is, right? If this could flood or could burn down, I need to know so I can make my investment decision. I could see a Trump having a view on that and maybe wanting to slow it down, or more just Republicans in general, not necessarily just Trump. That has a slow effect, but it doesn't necessarily change our investment. If you look at what happens in Canada, Alberta, I'm in Toronto, by the way, I'm in Ontario. Out west in Alberta, Alberta is arguably our most conservative province, right? Alberta has had the longest standing compliance market in Canada, despite being the most conservative province. So it's not one or the other. They can obviously work together, even with a more anti-ESG movement. The whole ESG movement was a bit extreme when it started, to be fair. And then because it was extreme, it extremely came back down. But this is something that's going to happen going forward, especially as the younger generation who are much more ESG focused become the positions of money managers, right? That will naturally happen. I'm seeing it myself. So we want to make sure that we're positioned for that. If a Trump came back in office, doesn't necessarily make a difference for us.
Well, I think even the carbon credits were originally, that whole market-based system was a sort of a right-wing think tank creation of how do we create market dynamics for creating kind of green goods. So it's just using a green initiative and putting capital markets behind it to create and value things. So in a sense, it's a very capitalistic system to to put value on something that hasn't been traditionally valued.
That's spot on, Martin. It's extremely capitalistic, which they all like, and so do we. We're an investment firm, but it's as simple as that. I mean, what we're doing with an Agnico or a Cenovus is you're turning what is supposed to be a cost center or a liability into a profit center, right? You can make money doing this. So why wouldn't you? It's a good business on its own.
Milton Friedman, I think, would love it.
Yes.
Vera has come under a lot of pressure due to perception of low quality, unsubstantiated credits in recent months. How is Green Star protected against this and other perceived or real issues with carbon credits?
Yeah. Look, there's noise in every sector that we've been involved with. I think coming from the mining industry where we have thick skin, we're used to it. Unfortunately, where it affects us, it's more headwind in terms of negative perception, right, and scrutiny. So I'll give you a couple of examples. With those projects that this audience member is asking about, there have been projects that have had clearly issues, whether it's overcrediting or other governance issues. They happen to be registered under Vera. That's not surprising. Vera is the biggest player when it comes to the registry. That has no impact on us. These are projects in Southern Africa, or in Southeast Asia that have nothing to do with us, completely different area, completely different projects. And it's a perfect example with mining as an analogy. Cobre Panama is a massive copper mine in Panama. Great mine, nationalized. It's been shut down. What does that have to do with what we're doing in Arizona or BC? Got nothing to do with each other, although you get the negative perception from that one mining problem, right? So same thing we see in the carbon space. In terms of, just remind me, Martin, the other part of the question there was on Vera, and was there something else that I'm missing?
The perception, be it real or perceived, that just low quality credits, and if you have some Vera certified carbon credits, does that sort of put a discount or what kind of negativity does that maybe add to your portfolio or to your business? Or
Right. Okay, thank you. So look, Vera is still highly valued. If you're a large emitter, you're buying Vera or Climate Action Reserve or American Carbon Registry, ACR, or Gold Standard. Those are the ones that you're buying. There are other ones out there, and they're fine as well, but you're buying one of those four. Just like if you're looking for an auditing firm, you're using KPMG or Ernst & Young or PwC or Deloitte, and those are the ones you're going to. So I wouldn't say that there's been a negative impact from that. The headwind comment that I was getting at, though, that's where it does hurt everybody in the space, because in the past, Martin, you were talking about this ESG movement in 2020, 2021. A lot of companies were talking about what they were doing on their sustainability front, on their carbon front, and some of that was very good. Some of that was greenwashing, which is not good at all, right? They're bragging about something that they shouldn't be bragging about. And fairly, those are the companies that should be scrutinized. But instead, you have a very select few news outlets that have scrutinized everything. And because of that scrutiny, there's a fear of public perception, right? People don't want to be publicly scrutinized. So what was greenwashing is now green hushing. And what green hushing means is that companies are doing this. They're buying credits, they're retiring. Last year was a record year of carbon retirements. Nobody wants to talk about it, though. So this is kind of the challenge that we deal with when you hear this news from Vera or from the news outlets like The Guardian. It doesn't hurt it doesn't help. It hurts the messaging, but it doesn't affect us on a fundamental level. If you have negative news from Boeing, are you going to stop flying? No, you're not, right? You're just going to say, "Oh, Boeing." It's the way it is.
when you mentioned retirement of carbon credits, I'm not exactly sure what you mean by that, or what are you referring to there?
Sure. So a project will generate a credit after it's been fully quantified, it gets verified, it gets serialized, it gets issued. Then whoever owns that credit will sell that credit to whoever. And then ultimately, the point of the credit is that you use it to retire it against your emissions. If you have a carbon footprint of 1 million tons and you want to retire 100,000 credits, you would retire it off of the registry. This is where you will go to Vera or any of these projects and say, okay, well, that credit was generated here by this group. It was ultimately retired by Shell or Air Canada or Netflix or whoever.
If you sold the mining portfolio, what would STAR do with those proceeds?
I think it's more a question of when rather if, but we talked about part of the use of proceeds, and part of the use of proceeds would be looking to allocate it to the green side, right? So let me just take a step back. When we sell this mining portfolio, we as a team and us as a board, we're going to have the discussion in terms of how do we allocate that capital, right? We're going to bring X millions of dollars for doing this. How do we best allocate that capital? Part of that capital will have to go towards Green Star. Now, I say this, of course, given our understanding of what life looks like today, right? And not in the future. But as of today, we've hopefully outlined to you, Martin, and to all of our participants here, why it makes sense more capital goes towards the green opportunity, because it's a great business to be building up, right? We want to get the most bang for our buck, like I said, right? What's the best way to get a return on the dollar that we can invest? Some of that money has to go, in my mind, to building up the green business. And on that point, most of the investors that we talk to that own Star want to own it for Green Star. It's Green Star that they actually care for, even if they were precious metals investors to start off with in the conversation. The other part of the conversation is, well, how do we return capital to shareholders, right? We want to reward our shareholders, especially our patient shareholders. We as a management team are shareholders. This is a big part of how we get compensated. How do we return capital to our shareholders? There isn't an answer yet in terms of X% to one, Y% to the other. But we want to be mindful of a balanced approach, and that capital goes towards building up the business that our shareholders will own and rewarding our shareholders at the same time.
I guess it's all hypothetical. Would if sell off the mining portfolio, you have the cash, would STAR Royalties deploy that cash directly into new green investments, or would you invest it into Green Star, who would then do the investment?
It's the latter, because Green
Okay.
Star is half owned by us and quarter owned by Agnico and Cenovus each. We would
Yeah.
put money in to buy a bigger portion of Green Star back. Pardon me.
Yeah. And you mentioned dividends, and I really generally dislike talking about dividends in early stage companies because that's down the road.
Yes.
Um, but like the capital allocation plan, would the plan be, because when you have positive returns, you have capital allocation choices. You can invest in more green royalties. And when you're in a growth phase, it kind of makes sense. Okay, let's push the growth and get that going. Or do you want to return some of it directly to shareholders through share buybacks or dividends and so forth? I guess the question is any thoughts on how big you would have to be before you would start sort of more direct return to shareholders, or how much longer you'd want to push everything into the growth side of capital allocation?
Yes, yes. So look, there isn't one particular answer here, because growth is a relative term based on what's happening as a company or as companies at that point, right? So if we're talking about a reoccurring sustainable dividend from cash flow, that is something that will happen. Royalty companies are typically famous for having that. This is a big reason why you want to own a royalty company, is that there's this redeployment of cash flow into the shareholders' pockets, right? Too early to do that right now, to your point. We need to have sustainable cash flow, meaningful sustainable cash flow, so that we can always pay out that dividend. The worst is when a company has a dividend and ends up cutting it. That's not a good thing to happen. So we want to have that reoccurring stable cash flow to redeploy into a dividend. What that amount would be to be determined. I think 25% of free cash flow would be a nice target for a dividend policy. We want a dividend policy as a management team because, well, like I said, we're large shareholders. Part of our compensation structure is to get paid back from the ownership, right? And I want to get paid the same way all of our shareholders get paid. So that's the dividend policy from a cash flow perspective. In terms of one-off dividends, that gets a bit more complicated because it's based on what's happening with the mining portfolio, based on what's happening with Green Star and Star. Are they potentially coming together? Are there tax considerations? This is all the boring stuff people don't like talking about, but with our large shareholders, they specifically want to talk about this because they may want that because they want to be rewarded, or they may not want that because of the tax implication. So we want to be mindful what makes sense for the shareholder in general. It's never one answer, but dividend is something that we would want to have. When Green Star is established, public, there would be a dividend policy in place.
And I guess looking at, let's say, your share price to book value ratio, I was calling book value a proxy for sort of proper value, the best allocation could be buying back some stock as well. That could be a great ROI.
That is arguably the better way to do it right now. And I know you spoke to Kevin, our CIO, 14 months ago. If he was on right now, that's what he would be talking about. Normal course issuer bid is probably the best thing that we could do. We're mindful of when we do what based on what could happen. But if we were steady state going forward and there was this kind of value disconnect, that's the first thing you would do.
Are there any meaningful revenues from Moby Smart royalty?
There are revenues. Moby Smart revenues are meaningful, relatively speaking. So look, it's a small amount. It would be in the tens of thousands of dollars right now, but it is ramping up quite significantly. And just to give some context for the audience, Moby Smart's that clean tech investment that I mentioned. Small investment. We put $300,000 into it. What's interesting about this one is it's a company level royalty, 2.5% on the business for 15 years, and they have the right to buy it back for $10 million. For $300,000 investment, they can buy it back for 10 million. So 40 times buyback. Unusual, but there's that kind of growth potential for this in the future. And if they were to go public on NASDAQ, let's say, they would likely want that royalty gone. We'd be thrilled if they bought it back for that kind of quantum. So there is revenue there. It's been generating revenue since early last year. It's been growing meaningfully. So this is why I'm saying meaningful from a quantum perspective. No, not yet. Meaningful from a year-over-year growth perspective? Yes, it's actually quite meaningful how much it's growing. And I'm very excited to see what it looks like going forward. There's some very exciting prospects for MobiSmart when it comes to decarbonizing telecom towers in the US with the big carriers or doing projects here in Canada. It plays out because everything takes time, but I could see MobiSmart generating a very nice amount of revenue for us as a royalty. I could see us having that royalty paid off in the coming years, and then you'd have a decade plus of extra cash flow coming out of it. That could be a very attractive return for us.
And we are having our final question here. So we're getting to an end of this. Thank you, everyone, for the great questions. I really appreciate it. Could you elaborate a bit more around AEs and Agnico Eagle?
I assume it's Agnico Eagle. Yes.
Yeah, okay. Agnico Eagle and Cenovus's strategic plans in making, I guess, future investments or making the investment in Green Star. And I guess there's a second part of this. Are they primarily interested in obtaining their share of the carbon credits for their own use, or do they have a mechanism to sort of, oh great, here's some carbon credits, don't give us the cash, we'll just take them ourselves and apply them to our business?
Okay, got it. It's a great final question, whoever asked it. So let's talk about why Agnico and Cenovus invested, and then let's talk about how and why they'll co-invest. So they invested in us, at least my understanding of it, is because they want to access offsets. What do I mean by that? You can buy carbon credits or carbon offsets at any point. That's literally the point of carbon offsets. You go and buy them from whatever project. To be able to put money in and originate those projects and secure offsets at a much better return, that's not easy to do, especially in your backyard. Like I said, a lot of these projects are in Latin America, Africa, Southeast Asia. They're not in Alberta. They're not in Ontario. They're not in Quebec. They're not in Ohio, right? Places that we're investing in. So the fact that we have this model where we put money in, and let's use Regen Ag as an example, Martin. Regen Ag, those credits sell for north of $20 a ton. If you do the math in terms of the capital we're putting into that project and the amount of credits we're going to be getting over that time period, that works out to about a couple of dollars a credit. So we're originating our share of credits, our attributable credits, at $2 plus or minus, versus them selling for 10 times plus more, right? So if you're a company like that, you want the optics of putting money to your local communities, and you want to be able to secure your offsets relative to the amount of competition buying the same offsets at a fraction of the price. So it's a no-brainer when you think about it. Agnico wanted to do this because we were doing these types of projects there. If you look at Cenovus is kind of the Agnico in oil and gas, and vice versa. Agnico is the opposite, right? So if you think about that strategic rationale, I think it's actually quite brilliant why Agnico and Cenovus would have co-invested. They're locking themselves in to jointly run this Green Star business. They're getting their foot in the door now, even though they know they have commitments for 10, 20, 30 plus years, because they have control, they have ownership of Green Star and access to deals. They can touch the pipeline. So that goes to the second point that you asked, Martin, in terms of co-investment opportunities. The first comment is Agnico and Cenovus will not co-invest in every single deal. We can clearly prove that out because we did the Native State deal, and that Native State deal was a Green Star deal. Agnico and Cenovus didn't participate. My understanding is that Agnico and or Cenovus, the co-investment partners, will co-invest in the deals that make sense for them. So let's say if we have a deal in Northern Ontario beside Detour Lake, I could see Agnico participating in that. Or if we have a deal close to Cenovus's operations in Northern Alberta, obviously I could see Cenovus participating in that. If we have the right deal that applies to their interest, to their criteria, if it appeals to them, they would co-invest. What happens when they co-invest? Let's say if we do a $20 million deal, of which we are maybe $10 million, and then Agnico is 5 and Cenovus is 5, or Cenovus is 10, whatever that split would be, they would do that likely because they would take those offsets for their own retirement purposes. If you look at Agnico's footprint, it's in the 1 million to 1.5 million tons per year, significant. But if you look at Cenovus, it's 20 million plus, very big carbon footprint, right? So these groups need access to volume. We're funding that volume into existence. We're bringing these projects online. They want to put money beside us so that they can get those credits and ultimately retire them against their footprint. For some reason, if they don't want to do that, they take delivery and they say, oh, well, we don't need to retire them this year. they'll have them marketed, they'll have them monetized alongside us. So they have the flexibility of doing one or the other, but strategically it's to get supply for the next 20, 30 years.
Can you give investors a bit of a view, and I know it's tough given all that you've said, over the next 6 to 12 months, what you can't talk about specifically what's going to happen, but what kind of initiatives are you working on, and what sorts of things do you could investors see come across their news screen regarding STAR Royalties?
Sure, sure. So look, this goes back to the catalyst and the value disconnect that we're looking to close that gap, right? So let's talk Green Star first and then Star. Green Star news flow that you would expect announcements of us selling offsets from native state, us taking delivery of more credits from native state, more investments under that native state structure. We will only announce the first one. There are already a few that are in the works, and we have more coming. So more projects, more dots on that map from native state. There alone, that one native state deal will generate quite a bit of news flow for us over the next 6 to 12 months. Region Ag, we had a few questions on Region Ag. You would expect news there. What's happening from a registration perspective, validation getting completed, verification getting completed, sequestration rates once that data is publicly available, volume of credits getting sold, the price that they're getting sold at, that's all 6 to 12 months away. What we do from capital raising, more on the private side, I would say, nearer term. If we do anything there, if we find the right partners, that's announcement. Deploying that money, that's announcement, right? Kind of like what we did with Native State and Synovus earlier this year. That's what you would see on Green Star, quite a bit of news flow that could come out of that. In terms of Star, two types of related news flow. Whatever happens from a mining asset perspective, if something happens with Copperstone in terms of advancement, some sort of milestone being achieved, some sort of M&A opportunity playing out, some sort of funding solution, which I think are all highly likely given the gold price environment that we have and their relatively depressed valuations, their share prices, that can all play out. Same thing with Elk Gold. You can see movement at these projects, and that bodes well for us. It bodes well for the value of our investments. It bodes well for the perception of value of our investments, and it obviously bodes well for our share price. And let's not forget, with Saber Gold, the operator of Copperstone, we own just under 10% of that business. We own 7.4 million shares. If that company were to ever be acquired and those shares are re-rated and under more liquid hands, well, we've made money off of that. We've already made money off of that. We'll make more money off of that. That's news. What we do with the portfolio, to your point, Martin, there's no guarantee we're going to do anything in the next 6 to 12 months, although we are looking. That could be extremely meaningful news flow that would, I think, cut that discount quite significantly. And you're not trading at 25 cents per share anymore because you've brought in more than 25 cents per share in value just on that deal alone, plus what we have on the Green Star side. So we're very busy. The whole team is working very hard on all of these opportunities. When you look at a Synovus deal, for example, those don't happen overnight. Those take a year to structure because these groups are extremely diligent. But investors should be comfortable that this bet has been made twice by Agnico and by Synovus, and then we'll have that kind of news flow going forward.
And I guess one final thing, Alex, how can you just put a bow on it for the audience here? What thoughts or impressions or perspective do you want viewers to walk away with today about STAR Royalties and Green Star?
Sure. So I hope people can summarize this on their own now after an hour and 37 minutes, but Green Star, highly unique. There's nothing like it. We have an extremely good starting point with incredible partners that are jointly running this business. Carbon is growing. There's a lot of news that's coming out, especially with what happened yesterday, with the US. If you want to be in an exciting sector, this would be it, and we're the way to play that. Buy Star, you get that at a huge discount. You can get that for half price. And then there's an entire mining portfolio that's worth a lot that nobody's paying for. It's our job as a team to unlock that value for our shareholders.
Alex, thank you very much. That was great. I really enjoyed it. I learned a ton here, so I do appreciate that. Thank you very much, and I'm looking forward to having you back and getting updates as the business and the portfolio evolves.
Yeah, thank you, Martin, for having us. I appreciate the invitation. Thank you to the audience as well for listening in, for being with us for that long, and for the great questions. If there are any other questions, if you want to talk to us more, We're available. Our emails, our phone numbers are all online. Please reach out anytime. We love talking to our shareholders and we love answering these types of questions. So thank you for having us, Martin, and thank you everybody for joining as well.
All right. Thanks. Have a great day and talk to you again soon.
Thank you. You too.